In market news now, global stocks are higher with Japan's Nikkei closing at its highest level in 33 years, drawing support from signs that cooling inflation might temper central banks' appetites to further hike rates. Traders were encouraged as data showed moderating inflation on Friday, even if it came at the expense of growth. Meanwhile, European shares rallied while U.S. equity futures pointed to a positive open for Wall Street, which closes early ahead of tomorrow's July 4th holiday. Investors await the minutes for the Federal Reserve's last policy meeting, which will be out on Wednesday, for cues on the central bank's monetary tightening path and why the Fed decided to pause rate hikes. For more, we are joined by Roy Mutuni, who's from Sanlam Investments. Roy, thank you so much for your time. Given the kind of trading picture we're seeing, especially when you look at your screens, what's underpinning the sentiment that we're seeing both globally and locally?
Hi, thanks for having me. It just seems like it's that investors are now coming to to appreciate that U.S. growth is still quite strong, that despite inflation, what you still have is an underpin for equity markets, and there's less risk of all of this recessionary talk happening for the second half of the year. So it looks like it's one of those good, happy stories for once.
So let's talk about those good, happy stories, and we're going to focus in just a little bit on what's happening on the tech side. And we're going to put a graph on screen for the viewers to see. You have Apple crossing above $3 trillion in valuation on Friday, and that just sealed the Nasdaq's performance, at least for the first half of the year. What's going on in the U.S. equity scene? Because this was a year that was supposed to be driven by fixed income, given where we are with interest rates and inflation.
So this is actually an interesting year. It's one of those years where we've seen fixed income rallying as well as equities. That rarely ever happens. And there's a variety of theories about that. Maybe interest rates were far too low and very stimulatory throughout the cycle, even when interest rates were being increased aggressively, and we thought it was going to push us into recession. What effectively they were doing was just taking away a little bit of the punch bowl, but they were still accommodative. In an environment such as that, when you're unsure about what's happening with the real economy and the cyclicals, what you tend to do is invest in these big tech companies that have solid balance sheets, good cash, and have largely proven themselves. So what's interesting is that it wasn't the loss-making tech that was doing really well. It's actually the profitable big tech that we all know quite well, and I think that's been the underpin to the market up until now.
So let's look back at that first half locally, that is. What were some of the sectors or stocks that stood out for you?
Yeah, the first half was a story of Richmond, the gold. That was it. That's what basically drove that's basically what drove the markets through this time. Towards the end, NASPER's process with all their restructuring talk and everything put on 10-15%, which put them onto the leaderboard as well. On the other side, the Platts were a complete pain trade. I think you could see all those stocks on average down 20-30%. And again, exactly like you're saying, just from the perspective that everything changed from what we thought at the beginning of the year. We all thought it was going to be recessionary. We all thought that China was going to come out aggressively and buy these commodities, but that's not what happened. Everything on the commodity side sold off, and then you have on the consumer side Richmond and NASPER's process doing well.
On that note about that recession fears, I mean, where's your recession call sitting right now? Or are we kicking the can further down the road? What's your assessment of it?
It's very hard to expect a recession based on the numbers that we're seeing right now. If you start with the US, it just shows the consumer there is quite strong. They're still spending. The job numbers are really strong. People are still being hired. We're still at the rate where I think you have 2 vacancies for every 1 unemployed person. So it's a really resilient economy happening there. And that's why the central banks are more than happy to keep hiking rates, because they believe that you'll not push the economy into a recession having higher rates, and what you'll do is manage the inflationary picture better. So I think talk of a recession, you'll hear a whole lot less of it, or as it comes down, unless of course you see a big macro thing, and geopolitics is always a step away. The Ukraine issue has not been resolved yet. China is still looking internally and trying to see what it can do to stimulate its economy. So I think it's premature to think about a recession as we speak.
On that note, then, what do you believe to be, I suppose, a key challenge for central banks, including the Reserve Bank right now?
Well, the challenge is that inflation is not coming down as fast as they expected. And you might actually reach this inflection point where you hike rates one step too far. And then that causes a problem. Exactly, a similar problem to what we saw with all of those banks in the US, or something like that, a credit crisis, a housing crisis, or something like that. In SA, clearly the issue is demand has really been hammered. You've seen it in the PMIs, you've seen it in the consumer sentiment indices, you've seen it in some of the trading updates that some of the companies have issued recently. Demand is really being pushed down. Those interest rates are really high. Unemployment is quite high. You'd rather have that we are stimulating right now, but you can't stimulate into a highly inflationary environment. So these trade-offs have to be thought about over the next 6 months. If the US continues to grow and continues to hike rates, we can't be left behind because we need capital inflows that we will not get if the gap is too high. The rand's behaving itself moderately as we speak for now. So it's a very tight rope that the SAB walks, and another tight rope that all the reserve banks across the world will walk. How far can they push interest rates to manage inflation expectations, and how far does this inflation come down? How fast?
Roy, thank you so much for your time this afternoon. That is Roy Muchini, who's a portfolio manager at Sanlam Investments, giving us his perspective on the latest when it comes to the markets. That is it for me. We're going to take a quick break. When we come back, we'll have more news for you. So stay tuned.